Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Today's video, I'm going to talk about an investment that's designed for those investors who are perhaps retired or real close to retirement, who are looking to build a portfolio of income-producing stocks that have the ability to increase their income every year so that the retired investor can live off of those dividends and then take those dividends and count on those dividends being larger next year than they are this year. That helps you fight inflation and keeps your income at a level that will allow you to maintain your standard of living regardless of inflation. It's a great inflation hedge. But one of the things about investments like this, a lot of people, I shouldn't say all people, because I get it in the comments all the time. That investment is not real good. Not all stocks are growth stocks. Not all stocks are the same. Stocks are situational. You want to utilize them to meet your own goals, objectives, risk tolerances, and needs. And that's very important. So we're going to talk about a company called Community Financial Systems here. This is a Dividend Aristocrat. They've increased their dividend for 32 consecutive years. And as I'll show you, they've got great cash flows supporting the dividends, both free cash flow and operating cash flow. And it's currently at a very reasonable valuation. Now, it's been dropping even today and yesterday as I'm doing this video. So the key is put it on your radar screen if you're looking for an income vehicle and then try to pick the right time. But I'm going to get a rather deep dive into the company, what it does, and why I think it's a good investment candidate. Because this particular Dividend Aristocrat also provides a very unique opportunity for capital appreciation. But there is some risk there. Let's talk about it. So looking at the fast graph, I want to take the thing apart a little bit. Now, the first thing I want you to note about a stock like this is it's not been a very fast grower and it's moderately cyclical, but not real cyclical. In other words, coming into the recession of 2008, we saw it had 3 down years of earnings, but it did stay profitable. And again, their dividend, which is the gold line in this graph, you can see increased every single year during this period. Then coming out of the recession of 2008 and 2009, they did have another down year where earnings fell a little worse than normal, down about 21%, but then they backed that up with a 40% increase. And then they had kind of flat growth for a next period of 4 or 5 years. Then they had a surge in earnings growth, and then the earnings flattened again. So you see sort of a pattern there. Okay, now the way the market likes to price things is not always logical. So let's put weekly closing stock prices. Now, the first thing you should see here is that stock prices are always the most nervous line on the graph. The most consistent line on the graph, of course, is the income line, the dividend income line. And so the key about buying a dividend-paying stock, and this company currently offers a dividend yield of 3.53% if you bought it at yesterday's close. It has a very attractive earnings yield of 7.1%. It only has 25.7% debt to capital. It's a rather small cap, $2.8 billion market cap, so the company has room to grow. Their payout ratios are around half, 45 to 50%. As I point to these dots on this orange line, you can see they're paying out about half of their earnings to their shareholders. Now, from a standpoint of the market valuing the stock, since coming out of the recession, you can see the blue line is a little higher than the orange line, which means the market has typically put about a 16 PE on this stock. But there were times when the stock got really overvalued. Now, this was obviously could be explained by the strong growth they had in 2017 and 18. But I also want you to note that once the stock got overvalued like this, you would have went several years not making any money on the stock, and that includes receiving the dividend. Valuation matters, and it matters a lot. The only thing really wrong here was you were paying way too high a price for a company that's not really that fast a grower. So the other thing you should take away from this is markets don't always appraise stocks correctly. Okay, and so when the stock price is dropping, if it's dropping from being way overvalued, but fundamentals are kind of remaining the same, that can be an opportunity to buy. Here we saw the fundamentals sagging a little bit, but modestly maybe is a better word. And then the stock got pretty undervalued. So anywhere during this period of time here would have been a good entry point for the stock. We're kind of in that position now, but there's something strikingly different on this graph, at least for the next couple of years. And I want to remind you of the patterns we saw historically. And that is analysts expect this company to increase earnings dramatically, almost 2.5 times higher than their historical average or even more. And what's the reason for that? Well, for one thing, the analysts are highly positive on CBU's earnings outlook for the next 2 years because of catalysts. For example, they made an acquisition of Santander Branches, another banking company, that's going to bring in $600 million in low-cost deposits, a major branch expansion in growth markets, and ongoing improvements in their net interest margin. So these are expected to drive loan growth, boost profitability, and diversify revenue streams. Now, I do want to put a cautionary tone on that. The reliability of these forecasts is probably moderate at best. If we look at the company's analyst scorecard, for example, we see that it's had an impeccable scorecard going out 2 years in advance. But these particular estimates, as you can see, for a 16%, 39% growth rate out to the end of fiscal 2026 is actually pretty high based on their standards. Now, if it were to trade at a 16 PE, which is a PE equal to the growth rate, you could actually make about 33% a year if the stock reverted to the mean, as it has. And if it got above that, you could even do better. If it did above, you could earn 50 or 60. If it traded closer to that 14 PE or 15, here's 14.75, you could still make over 20% annualized rate of returns, at least for the next 2 years or two. But that's not what this stock is all about. That's a bonus, in my opinion. What this stock is all about is a company that's increased its dividend consistently. Now, let's look at dividend coverage, okay? I like to look at operating cash flow. And what I want to see here, I'm going to get price off the graph and the normal PE. I want to see this orange line, which is the cash flow, being much higher than the gold line, which is the dividend. Okay, so we've got $2.59 covering $1 dividend in 2011. We got $2.72 covering $1.06, and so on. Now, if I go into our performance report, I want you to note that the dividend has grown at an average rate of about just over 5% and a compound dividend growth rate of over 5%. That's a little higher than the company's actual growth rate. But if you bought the stock years ago, and before I do that, let's check. The current yield is now 3.53%. Okay, so I want to put that into perspective by going into the performance figures here and looking at, I'm going to try to find, here's 3.54%. Okay, so that's consistent with what the dividend is now. And you can see in the next year, the dividend, your yield would have increased to 3.75%. Then it would have increased to 3.89, then 4%, then 4.3%, 4.5%, 4.67%, over 5%, over 6%. You'd be getting 6.5% yield. Now, I call that growth yield. Most of the industry calls that yield on cost, and that's how we label it on the fast graph. But also looking at the all-important free cash flow to equity, I want you to note that this company, other than just coming out of the recession for one very short period of time, they've had ample free cash flow covering their dividend. So the key here is this is an income vehicle, I want to remind you. We're investing here for the dividend and the dividend growth potential. And this is a stock that you would blend with other stocks in an income-producing portfolio where you're starting out here with a base yield of about 3.5%. You could mix it with some higher yielding stocks, some lower yielding, faster growing stocks, and you could, again, put together a portfolio that would give you a nice, attractive income and an income that would be able to grow each year. And that's what I think is the biggest advantage here. Now, going into fiscal fitness, a couple of things I want to point out. We've looked at free cash flow already. Let's look at margins a little bit. All right, and what I want to look at, I'm looking at quarterly margins here, operating margins, and then net margins. And what we're seeing here is the margins have held up really well over this period of time. If we look at things like return on assets, once again, they've held up and even slightly increased a little bit. Return on equity has actually held up and increased a little bit. Return on invested capital has held up and even, well, maybe just a little decrease in the most recent year. But the bottom line is the fundamentals of this business look really good. Now, here's the point about looking at it today. The key is, remember I've said this so many times to you, the idea of being a value investor, understanding that this orange line represents a formula, a version of discounted cash flow that basically calculates the intrinsic value of the business based on what it's produced. This is a historical graph, all right? So this orange line, anywhere you touch the orange line, that would be the theoretical intrinsic value of the company. Now, if I put weekly closing stock prices back on the graph, and the fact that it went through a long period of overvaluation here where we see that the blue line is a little higher than the orange line. The orange line here is a 15 PE. That's what the stock ought to trade at, in my view. Okay? Today, it's trading at a 14.07 PE, which gives us an earnings yield of 7.11%, which gives us a slight margin of safety in the stock. If I look at forecasting, it's about 10 to 14 or 12%-ish with a margin of safety built in. So what happens is, if you bought this stock today and the company's earned what analysts expect, now admittedly there's only 5 analysts following the company, but if it did that and your PE ratio increased to 15 and your dividend yield increased by approximately the growth rate, you stand to make 33% a year out to the end of 2026 as an annualized rate of return. And that's where the margin of safety comes in. Now, assuming the stock traded at, it's currently at a 14.07 PE. So let's look at it here and below that at a 13 PE. Get rid of this first. You'd still be able to make over 14%. So that's where margin of safety kicks in. I think you have a great risk-reward ratio here with this particular company. Now, we can talk a little bit about what the company does. I can go into the summary here and give you a quick look. Community Financial Systems is a holding company which engages in the provision of retail business and municipal banking system. It operates through the following segments: banking, employee benefit services, and all other. The banking segment offers lending and depository-related products and so on. So it's a financial lender. Okay, they've just made that acquisition of those several branches, which are giving these analysts some positive thoughts. So all in all, when I look at this, this is not I'm going to get you rich, or this is not I'm going to make you rich investment. This is not a high-flying AI or high-tech stock, but it's a very stable income producer. The key to focus on is the gold line on the graph. 32 years of increasing the dividend that is extremely well covered by cash flows, and the company does appear to have a very bright future. Now, keep in mind, if the Fed cuts interest rates and things, that could even be more positive for the company. Okay, and there's talk about they might do it on the next go-around, but they didn't. They kept them the same here recently. But the point I'm getting at is this is an income vehicle. The valuation is attractive now. You have to decide whether you're going to wait for it to maybe drop a little lower. We did see it get down to PEs of 13 here just recently. It's trading at a 14 multiple now. Bottom line is, though, if you're looking for income and you're looking for a steady dividend increase or a dividend aristocrat or champion like this is, and with 32 years of raising the dividend, this would probably be one you'd really want to look at. And by the way, let me also stop the video here and point out, there's some friends of mine, Brad Thomas and Nick Ward, have a YouTube channel called Wide Moat, and I was privileged to be the guest on their channel. I'm putting a link here at the bottom of my video. You might want to check that video out if you want to learn a little more about value investing and how value investing works. That was primarily the subject that I contributed to the video. But anyway, thanks for watching this video. If you liked it, give me a like, ring the bell, subscribe to our channel if you don't already, and take a look at Fast Graphs. It's not only the value investor's best friend, but it's a tool that can help you make sound and profitable long-term investment decisions. And it's built for the long-term investor, not the day trader. Thanks for watching.